98% of hedge funds fail to beat the S&P 500 over 20 years. Here's the math they don't want you to see. Hook_ND. Let's start in 2007, at a conference in New York. Billionaire investor Warren Buffett makes a public bet: any hedge fund manager can pick any 5 funds they want. Over 10 years, those funds will underperform a simple, boring S&P 500 index fund. The prize? $1 million. Pattern_interrupt. Ted Seeds, a hedge fund executive, takes the bet. He picks a portfolio of 5 funds of funds, which themselves invest in hundreds of hedge funds. It's the smartest, most diversified hedge fund strategy money can buy. By 2017, the result is in: the S&P 500 index fund returned 125.8%. The hedge fund portfolio? Just 36.3%. That's not a typo. The index fund beat the hedge funds by almost 3.5 to 1. Cliffhanger: how is this possible when hedge funds charge massive fees and employ the brightest minds on Wall Street? Act 1, the setup. First, let's understand what a hedge fund actually is. The name comes from the idea of hedging, reducing risk. But in practice, hedge funds are lightly regulated investment pools that can use leverage, short selling, derivatives, and exotic strategies. Their pitch is simple: we will deliver high returns with lower risk than the stock market. Pattern_interrupt, and for decades, this pitch worked. In the 1990s, hedge funds like George Soros's Quantum Fund and Julian Robertson's Tiger Management posted annual returns of 30% or more. They were legends. But here's the dirty secret: those early returns were a mirage. They were achieved in a small, inefficient market. Once hedge funds became mainstream, managing over $4 trillion by 2022, the easy alpha vanished. Cliffhanger: yet the fees stayed high. And that's where the trap snaps shut. Act 2, the mechanism, fees. Let's talk about the standard fee structure, 2 and 20. That means 2% of assets under management every year, plus 20% of any profits. Imagine you invest $1 million in a hedge fund. Year 1, the fund returns 10%. You make $100,000. But the fund takes 2% of your $1 million, that's $20,000, plus 20% of the $100,000 profit, another $20,000. So you pay $40,000 in fees. Your net return? 6%. The S&P 500? Also returned 10% that year, but with an expense ratio of 0.03%. You paid $300. Pattern_interrupt, over 20 years, that fee gap compounds into a chasm. A $1 million investment in the S&P 500 at 10% annual return grows to $6.7 million. The same investment in a hedge fund with the same gross return but 2 and 20 fees? Just $3.8 million. The hedge fund manager takes nearly $3 million of your money. And that's assuming the hedge fund matches the market, which most don't. Cliffhanger. But fees are only half the story. The real killer is human nature. Hedge fund managers are humans, brilliant, overconfident humans. They churn portfolios, trying to time the market or pick winning stocks. Studies show the average hedge fund holds a stock for just 6 months. The average index fund? Forever. Pattern_interrupt, this frenetic trading generates huge commissions and tax bills, but it doesn't generate alpha. A 2018 study from Yale found that hedge fund returns were almost perfectly explained by market beta, the stock market's general direction, minus fees. In other words, hedge funds are just expensive index funds with worse behavior. Cliffhanger. Act 3, survivorship bias. Here's a dirty trick in the data. When you look at hedge fund performance, you only see the funds that survive. The ones that blow up, and there are many, disappear from the averages. This is called survivorship bias. Over a 10-year period, about 30% of hedge funds go out of business. Pattern_interrupt, a famous study by the Hennessy Group found that from 1994 to 2014, the average hedge fund underperformed the S&P 500 by 1.8% per year. But when you include the dead funds, the ones that lost everything and shut down, the underperformance jumps to 3.5% per year. The published numbers are a lie by omission. Cliffhanger. Now let's address the misconception, but hedge funds protect you in a crash. This is the biggest myth of all. During the 2008 financial crisis, the S&P 500 fell 38%. The average hedge fund? Down 19%. Yes, they lost less. But over the next 5 years, the S&P 500 rebounded 180%. The average hedge fund? Up just 60%. Pattern_interrupt, the hedge fund protection cost you 120% in missed gains. You don't need protection from a crash if you're willing to hold for the recovery, and index funds let you do that for free. The hedge fund's downside protection is just a sales pitch for high fees. Cliffhanger. But let's look at the outliers. There are hedge funds that did beat the market. Renaissance Technologies Medallion Fund, for example, averaged 66% annual returns before fees from 1988 to 2018. Pattern_interrupt, but here's the catch: Medallion is closed to outside investors. It's run by mathematicians using secret algorithms. And its success is almost impossible to replicate. Most hedge funds chasing that dream fail. The Medallion Fund is the exception that proves the rule. Cliffhanger. The takeaway? Index funds win for one overwhelming reason: they remove human emotion and cost from the equation. The stock market is a chaotic system. Trying to outsmart it is like trying to predict the next earthquake. Pattern_interrupt, instead, index funds accept the market's return, which over the long run is positive and substantial, and keep nearly all of it. Hedge funds try to beat the market, fail 98% of the time, and charge you for the attempt. The math is ruthless. And it's not getting better. Cliffhanger. What does the future hold? Hedge fund fees are finally falling. Some now charge 1 in 10, but they're still 10 to 100 times more expensive than index funds. Meanwhile, the index fund industry now manages over $12 trillion. The era of active management is over. The data is clear: the best investment strategy is also the simplest. Don't try to beat the market. Join it. Pattern_interrupt. Here's your actionable insight: if you're paying more than 0.5% in fees on any investment, you're likely losing. Check your 401k, your brokerage account, your IRA. Look for the expense ratio. If you see a fund charging 1% or more, ask yourself, is this manager really going to beat the market by that much? The odds say no. Cliffhanger. This isn't about being lazy. It's about understanding that the financial industry profits from complexity. The index fund is a rebellion against that complexity. And it works. Pattern_interrupt. If you found this useful, hit like and subscribe. More deep dives into the hidden mechanics of money are coming. And comment below, do you own any active funds, or are you all index? Let's see where the audience stands.